Mortgage update. My name is Sean Woolen with the Woolen Mortgage Team, and I'm going to try to explain to you what in the heck happened with the Fed funds rate being cut, why everyone thinks that mortgage rates are supposed to be lower, and what happened. So I'm going to explain it to you. I'm going to help you explain it to your customers, and then I'm going to go over a little bit more about mortgage rates. I really want to help you understand so that when customers come to a lender like myself and they get a rate quote, what is behind that? Because I still get questions all the time, what is your rate? And it's almost like saying, how much is a condo, right? It's like so open-ended that it's hard to explain. So I'm going to go over that a little bit more. And I'm excited to show you kind of what's happening in today's market. So here we go. I'm going to go ahead and get started here. Yes, the Fed cut their rate by 50 basis points. Mr. Powell, notice the look on his face, though. I think he's a little uneasy here, but anyhow, that's a whole nother topic. But let's jump into what happened. So the Fed funds rate was cut by 50 basis points. This is what CNET Money website said. Mortgage rates plunge on Fed Day. Today's mortgage rate, September 18th, 2024. Okay. No, they did not. But this is what the headlines are saying. Mortgage rates plunge on Fed Day. No, they did not. But this is what everyone is seeing. Everyone is hearing that mortgage rates went down 50 basis points and that it's this big movement and we should all be super excited. Yes, we should be excited for the Fed funds rate to be cut, but it did not impact mortgage rates on a long-term 30-year fixed like FHA, conventional, jumbo on the long-term fixed rate mortgages. It didn't affect them at all. In fact, mortgage rates got worse. We'll talk about that in a second. But this is what the public is hearing. So my phone is blowing up. Everyone's saying, oh my gosh, why did we lock earlier? And I'm saying, don't worry. Actually, you're in a better position now than where rates are currently. But this is what we're seeing on the news. And it's just, it's frustrating, but this is what we're seeing. So I want to go into kind of what happened, what the Fed said, and kind of what the next steps are. So bear with me one moment. If I can get this to work. Oh, there we go. So this day right here, I'm going to circle it so you guys can see. This is the day, this is the bond market on long-term mortgage-backed securities on Fed Day. So they cut 50 basis points and the bond market did not like it. So the bond market actually lost about, let's say about 25 to 20 basis points that day. The next day, we tried to recover, come back a little bit, but we stayed on that Fibonacci level. So we're kind of stuck in the middle right there. But this is the Fed Day. Mortgage-backed securities did not like the fact that there was a 50 basis point cut. And again, it's not the cut that they didn't like. It's what the Fed chairman was talking about. And it's how the bond market, the long-term bond market, is reacting to what the potential impact this could have on the rest of the economy. So when we're talking the rest of the economy, we're talking inflation, we're talking the jobs numbers, we're talking overall economic activity, we're talking about GDP. All of those things impact long-term mortgage rates. So we saw the mortgage-backed securities go down. So notice where we are right now. The day before Fed Day was right here. Okay, this little spot right here. This was the day before the Fed cut. We were in a better position. After, we were in a worse position. So that's what happened to the mortgage-backed securities. That is what why you can see why mortgage rates dropped. But look at the 10-year. Now, remember the 10-year. If I can get this to work properly. Why isn't it moving forward? Come on, baby. There we go. The 10-year went up drastically. So the 10-year was down to like 3.65, and it went up all the way above this. This is the 25-day moving average. It's above it today. So not a good sign for mortgage-backed securities for time to come, because this has a lot more room to get to that Fibonacci level. So we could see mortgage rates get worse as we continue through the week. So that's the 10-year. Now, remember what I talked about the Fed cut rate, the Fed's fund rate back in 2008? the mortgage rates were right here. I'm going to circle it. Mortgage rates were right here. The Fed cut the Fed funds rate drastically, very quickly, very, very quickly, all the way down to 0 in a year and a half. Huge. Now, look what mortgage rates did. They went down and then they went up in this same cycle. So it's not unheard of that you see a ton of cuts and mortgage rates not follow suit. Now, eventually, they did start to come down, but never in a straight line. So it took a lot of time because the economy was getting worse and worse and worse through this. We all know what happened during that 2008 to 2009, 2010, right? The markets were kind of rough. That's when rates continued to come down. So it's not unheard of for mortgage rates to get higher when the Feds are cutting the interest rates. It's just really interesting to see. So let's look at what the Feds actually said. So the Feds cut the interest rates by 50 basis points. So now we're about an average of 4.875 because it's a range. The target is 4.75 to 5. So let's just say it's 4.875. Now, most of them wanted the 50 basis point cut, but one of them, Governor Bauman, they wanted only 25 basis point. It's the first time in a long time that one person that was in dissent over the rest of them, but we'll get into that a different time. But remember, the Feds have a dual mandate. They need stable prices with inflation and maximum employment. So they're a little afraid of unemployment right now. And they're pretty comfortable that the inflation numbers are going to hit that 2%. So when they're in the 2% range right now. But oh, interesting. Look at this little scribble on here. But anyhow, employment job, they said, and this is Powell, they said that job gains have slowed. Now, before it was job gains have moderated. Now it's slowed. So they're admitting that the job sector is actually slowing down, which is going to be good for mortgage rates in the near future. And then unemployment has moved up to 4.2. Now, most of the Fed governors, didn't expect it to move above 4.1. So that 4.2 is kind of like the golden ticket for mortgage rates to come down. And that's what happened over the last couple of weeks. The unemployment number was higher than expected and mortgage rates came down. That's what drove interest rates to come down the last several weeks. So they also mentioned, the Fed mentioned that the economy is still solid. I don't believe that. I think people are a little overextended. I think the spending that's happening is based on money that they don't have, not money they have, because the savings number has gone way down and credit card usage is going way up. And then he also said quantitative tightening is going to continue. Remember, this is when the government, the Feds, are selling off their balance sheet. Now, keep in mind, when they were buying mortgage-backed securities, building that balance sheet, when they're buying, rates went down, down, down. When they sell, rates go up, up, up. So we're not going to see a fast, drastic move downward in rates because it's a tug of war. We're seeing the unemployment numbers go higher, but if they continue doing the quantitative tightening, which is selling off their balance sheet, that will continue to try to keep rates a little bit higher. Now, it's not as aggressive, but they are still doing it. So it's going to be interesting to see. Now, what is the forecast, guys? What are we going to see moving forward for the end of the year? What is the Fed going to do and how will that impact inflation, unemployment, et cetera? So here it is, guys. Here's the forecast for the rest of the year. The Fed's funds rate is most likely, most of the governors are expecting a 25 basis point in November and another 25 basis point cut in December. And then they're expecting another 100 basis point cut next year throughout the year. So that's a total of 150 basis point more in cutting to the Fed funds rate. Now, that's going to have a pretty big impact on the economy. What they're afraid of is inflation. Now, if you heat up the economy because you think that you're going into a more recessionary state, if you push the gas on the economy, which is what lowering the cost of funds is, you put the gas on, it could have an impact on inflation, and inflation could actually heat up a little bit. So that's why there's a little bit of a stalemate right now in what mortgage rates are doing. We need to see how this is going to impact inflation for the next couple months. So we have some inflation numbers coming out this week, but that's going to be on the previous month. So we'll have to see in November what October looks like for inflation and see really how that impacts mortgage rates. If inflation continues to go down, we're going to see mortgage rates continue to slip lower and lower. So that's going to be what we're really watching, as well as the unemployment. So inflation is supposed to get to 2.2 by the end of 2025. We're going to watch that, make sure it stays low, and that's how mortgage rates will continue to get lower. Also, unemployment rate is supposed to go up to the 4.4. Notice how it's going to kind of stalemate for the rest of the year into 2025. The projections are going to stay the same. So we'll see what happens there as well. And then GDP is going to go from 3% to about 2% by the end of next year and by the remainder of 2024. So we're going to see the economy slow down and then just kind of become steady Eddie, it looks like, for the next year. But with mortgage rates and with the Fed funds rate being cut, we really are going to be watching inflation and unemployment to see how low the rates can go. If everything stays the same, we may see mortgage rates stay exactly the same. So they expect them to drop, but if nothing changes, we're probably going to be stuck in the mud right now, kind of on where rates are right now. So this is the dot plot. Hold on while I erase this weird, I don't know why this is here, all these squiggles. This is the dot plot on what the Feds say is going to happen for the next couple years. So for the rest of the year, we're going to see 9 of them are saying 50 basis points by the end of the year. Only 1 is saying there's going to be 75 basis points for the end of the year. In 2025, you've got 1 person saying there's only going to be 1 cut, 3 people there's going to be 2 cuts, and we have 6 Fed governors saying there's going to be 100 basis point cuts. And then we've got another 6 saying there's going to be even more than that. So we're going to see what this ends up happening. Again, it's based on inflation and jobs numbers, what lever they're going to pull. But look at the future, more cuts in 2026 and continued in the long run. I mean, they're going to keep cutting. So we're going to see lower for a while, but we'll have to see how mortgage-backed securities and mortgage rates respond. And remember, that's based on inflation and unemployment. And that's going to be kind of the thing we're really paying attention to. Okay, so unemployment rate, the forecast. Remember, this dotted line right here was the June projections, that it was going to be at 4.1 and it wasn't going to go lower than that. Well, guess what happened? We hit 4.2 on the unemployment, and now they're thinking it's going to be 4.4 to 4.5. Most 10 Fed members is going to go to 4.4 to 4.5 in the future. So unemployment forecasts are going to be going up. That is a sign of a recessionary environment, and this should help mortgage rates. Now, if this doesn't happen, it's not going to help mortgage rates. But if this does happen, mortgage rates should come down. So the Fed doesn't see a recession. I say there's actually a industry-specific recession that's going on. Some industries are seeing great numbers. Some industries are seeing a recessionary period. I can tell you that there's some car manufacturers that are seeing recessionary. There's some that aren't. It's very spotty right now. It's not like the whole economy is in a recession. There's some parts of the economy doing great. There's some that are not. So he says we are not in a recession, so we'll have to see. GDP is coming down. He says that spending and growth have remained resilient. I think that's in part for a lot of credit use, and because the overall savings rate, and this is kept people, they keep track of this, how much money is going from paycheck into savings accounts. That is really, really low comparatively over the last decade. So we have to be careful. We have to watch that. Now, the Fed's also said that they aren't behind. They said the 50 basis point, even though it's a pretty big cut, it doesn't mean that they were behind or that they're going to fall behind. They don't think they're behind the curve on this. They think they're getting in front of it. I think that's a little off, but that's my opinion. And I don't think, and the Fed say, you're not going to see another 50 basis point cut in the next one. It's going to be small, gradual moves from here on in. Also, market rents are coming down, but very, very slowly. That's going to help the overall inflation numbers, because that's like over 40% of the inflation numbers is rents. So it's going to be really interesting to watch that. Now, housing inventory. People say, oh my gosh, there's a lot more homes on the market. Okay, let's look before COVID. we were at 1.24 or 1.24 million active listings, 1.24 million active listings, and now we're only at 909. Now, have they gone up since this last year? Absolutely. But keep in mind, they're still well below where they were 5 years ago before the good old COVID hit. So we're still low. Are they higher? Yes, but that's okay. We're still lower than we were. So just interesting. So people are seeing more homes in the market. There's a lot more to choose from, and that means more competition as well, but not as much competition as it was back in August. And how come this arrow isn't working? This is good times. There we go. So when people say, what's your rate? I can answer, well, what's your budget? Because it depends. And I'm going to go through here some different rates, but I want to show you something that maybe you've never seen before. And this is the loan level pricing adjustments for each of the different types of scenarios that are out there. And what we as lenders look at, here it is, what we look at when we are pricing loans. So let's look at this real fast, and I'm going to circle a lot of stuff here. So 20% down, this is this bucket right here, 75 to 80% loan to value range, 20% down. If you've got a 780 or greater credit score, it's only a 3/8 adjustment to rate or to the pricing of the loan. But look, if you have a 720, you have to pay an extra 0.875. So it's 1.25 points to get that same rate. 1.25 points to get the same compared to this one up here. Now, let's look to see if you have a lower 640 credit score. It's 2.5 points with 20% down. Now, let's just say it's a condo. You have to go down here. Condos. Condo, I'm going to circle right here. There's a 3/4 discount point cost just for it being a condo. Now, what if it's a condo investment property, right? So now you're an investment property. That's, if you put 20% down, that's 3.37% points more than the flat cost just because it's investment property. And then it's a condo, it's another 3/4 of a point for a condo. And now you know why the rates are higher and the fees are higher on investment properties. And then if you look at other items like second home, remember how there wasn't any adjustments for second home prior to 2.5 years ago. The second home rates were the same as a primary residence, but now these are the same, investment property and second home, the adjustments are the same. So now there's no benefit, second home versus investment property. We all know how that looks like for our buyers that are looking at second home now because the rates are like, oh my gosh, what happened? But all of these little tiny adjustments are what we calculate and have to add for each and every person that's buying a home based on their circumstances. So notice there's no adjustments here when you do 30% down. There's no adjustments. There's a small adjustment for condo, but here there's none. So the more you put down, the better the rate. And that's where we get into the mortgage rates. So when you say, what's your rate? Here's a nice little, let me remove these little circles here. There's a nice little calculator that I always go back to. If you have 30% down, 800 credit score, you're going to have a fantastically low rate with no points. Once you do like 10% down, you're at 6.25. But look at 15% down, it's higher. Why is it, you might say, that with 15% down, you're at a 6.4 almost? But if you put 10% down, less down, why is it a better rate? Let me answer that for you. At 10% down, the mortgage insurance coverage is a lot more robust. It's a bigger insurance policy, so it takes the risk away from the lender. So the less risk, the better the rate. So if somebody is asking me for the best rate, you may say, you know, with 10% down, you can get a little bit better rate because with 15% down, you're 0.15 higher in rate. So a lot of differences here. And if you do 5% down, it's better as well. Now, when you go to 3% down, it's still better than 15% down. Crazy, blows your mind, right? So that's because mortgage insurance is involved. It's a bigger policy. And then you do 20% down and it gets even worse because now there's no insurance on this at all. And it's the risk falls on the lender completely. So that's why you're seeing a little bit higher rate there. And then to get the best rate, you do 30% down. And then you add in all the loan level pricing adjustments for condos and everything else, and it becomes kind of crazy. So when people say, what's your rate? We really need to be careful because it could be so many different things due to so many different factors. Loan product, interest rate. Look at interest rate 660. You do a 640 with 20% down. Look at that. You're at 7.6 today on a standard 30-year fixed. And that's just because of your credit score. Change that back to 800, you're at 6.4. So literally more than 1% higher in rate just because of credit score. And that's a 20% down. So credit is a massive impact, has a massive impact on overall rate. So I wanted to show you that because I think it's important for you to understand if you see your customer at the closing table and their rate is higher than somebody that you had a closing the day before that you saw by a larger amount, it's not because that lender may be more expensive. It's because their loan circumstances require a higher rate. So just be careful when you're looking at that. And when people say, oh my gosh, this lender's rate's so low, why is this, or this lender's rate so high? Now you know what's going into it and how they're quoting, because one person might quote you 30% down, this is my rate. Or if you say, what's your rate today? What is the lender going to say? Are they going to ask you all the questions? No, they're going to give you the best rate that's available. My rate today is 5.99 with no points. That's a single family detached home, 35% down, 800 credit score, primary residence, all of the bells and whistles with escrows, and that's going to get you the best rate. That's what they're going to quote. And then once they get all the details, okay, now it gets a little crazy. That's one of the reasons I do not advertise rate. It really does set improper expectations. So if somebody sees that rate and they don't read the fine print and then they get a quote and it's a lot higher, they don't understand. So that's why I think it's important to really, when you're quoting rate, it has all of the information that you need to properly set expectations for that particular buyer. So it's a crazy world, this rate world, but that's kind of that's why I say, what's your budget? Because you can get any rate. If you want to pay for all those loan level adjustments out of pocket, you can do that to keep your rate low. That's where discount points come in. That's why those exist, because those loan level pricing adjustments, if you want to pay those out of pocket, you can to keep your rate low. Otherwise, we boost the rate up to adjust to absorb those costs. So anyhow, hope that you understood that. Hopefully that wasn't clear as mud. But let's see what's happening this week. We have a big week with inflation. So if you look at Friday, we have PCE. So I'm gonna circle that for you real fast. We've got Friday PCE. This is the inflation number. These two pieces right here. We have the core numbers as well, and then we've got jobless numbers, initial jobless claims on Thursday. So a lot of auctions happening. Auctions, remember, that's how the government raises money because they don't have any. We are spending money on credit cards. Always a scary conversation. But look at all these auctions, lots of auctions. So it's going to be a very volatile week this week due to the end of the week as far as the inflation numbers, the jobless claims, the auctions, and we have a lot going on this week. But this personal spending is going to be interesting to see as well, because people are spending a lot. They're continuing to spend the same amount, but on credit. So I've always been kind of afraid of this. I'm hoping this doesn't kind of bite us in the rear end, which we all know the United States likes to put things on the good old swiper, good old credit card, right? So we're going to be careful watching that. But that's our Monday morning mortgage update for today. Don't forget, we have the $5,000 pre-approval guarantee. And again, if our pre-approvals don't come through because we have a platinum loan approval, which is a fully underwritten pre-approval, we issue a $5,000 guarantee to the seller that if our buyer buys their home and for some reason the loan doesn't go through, if it's the lender's fault, we will give that seller $5,000. So a good peace of mind there. And keep in mind, these little red states are the only ones we don't finance. Every other state is where I am licensed to do home loans in. So that's the power behind being a mortgage banker, broker, and a bank. We have the FDIC charter because of the bank, but we're a banker. We do everything in-house. Plus we can broker out all states except these little two. So keep that in mind. If you have any customers moving out of state, here's my contact information. And that's basically it for today. So any questions on what's happening with the markets? Do you guys have any weird things you've heard from buyers on what's happening with rates? Are people confused? What are your thoughts out there from seeing it on the streets?
I agree with you. Everyone thinks that they're going to go down with that, and they didn't. And a lot of people were for sure disappointed.
Yeah, it's one of those, I get, comes back to setting expectations, right? When you hear on the news that mortgage rates are coming down or rates are coming down, the public has no idea. The normal everyday person, heck, most real estate agents and lenders don't even understand that. So it's hard to relate that to the everyday person that's super excited to finally see mortgage rates come down. But here's what I want to make sure you understand too. Home equity lines, those are tied to the Fed funds rate. So home equity lines are based on short-term, they're adjustable rate mortgages. So adjustable rate mortgages will be impacted and those will come down. But long-term mortgage rates are based on long-term fixed income bonds, mortgage-backed securities. And that's where the Fed funds rate does not impact those. So your home equity lines, those will come down slowly. As the Fed funds rate is being cut, those will be impacted, but normal everyday mortgages, when you're purchasing a home on a long-term 30-year, whether it's an FHA, a VA, or a conventional loan, that's a long-term play. So it is really hard to help customers understand this. Sometimes they look at me and they're like, oh, that's just an excuse. I saw where I can get, a letter in the mail told me that I could get a 4.99 rate. You at 6.25, you're way higher. Your rates are ridiculous. And then I have to say, okay, call them, get an estimate written out. Let me see the fees there, because I promise you, you're paying a lot of money to get that rate. Because remember, guys, you can get any rate you want at any time if you want to just pay to get it, because there's costs involved. That's why what's your rate? Well, what's your budget, young man? Right? That little Western thing. It's true, because you can get any rate you want depending on how much money you want to spend. So any other questions out there? What are you guys seeing? What do you see looking at the psychology of buyers? Are you seeing people hop off the fence with the news of rates coming down?
I seem to have buyers that are really worried about the election.
Oh yeah.
If their politician doesn't get in, the world's going to come to an end.
Yeah, so a lot of people are on hold right now because of that. You have no idea some of the crazy things I've heard. I mean, it's like people lose their minds during election season. It's pretty wild to watch. But you just have to know that people's behavior that's emotional really can be dangerous. So we need to make sure that we're not getting too emotional with any of these, because what really drives interest rates are things that are really, think of our economy as a huge, ginormous diesel engine. It's going. It might be dirty and clunky, but it's going to take a lot to really slow it down. It's clunky, it's dirty, it's gross, but it's going to keep going. It's going to take a lot to derail it. So as we go through this election cycle, there's not going to be massive it's overnight. It's just not how the markets work, unless something crazy happens where that thing just blows up, and then it's not a good thing. But it's a big engine, right? That's going. There'll be little moves here and there, and different policies might, go one way or the other. But for the most part, it's what the long-term goals are and the long-term projections that are really going to impact the mortgage rates. So that's what we need to be really focused on. All the social stuff and all the different fights between that is not going to have too much of an impact on mortgage rates. But what does impact it is spending and overall what the health of and the wealth of the consumer is. That's going to be the most important thing that's going to drive interest rates. And remember, bad news in the markets is typically good for mortgage rates. It's hard. It's sad to say that, but When were the mortgage rates at their lowest point ever? The whole economy was shut down, right? It's like, oh my gosh, mortgage rates, why are they so good? It's because the feds were like, what do we do? Well, if you guys remember, and you may not remember this, but when COVID hit, mortgages overnight, and it was a 2 to 3 day window, went from like 4s horribly higher, and they spiked. Mortgage rates went super high, and the bond market freaked out because the whole market was shutting down and there was no safety net. And then the feds came in and started buying billions and billions of mortgage-backed securities to bring the bond market back down to reality. And then they kept buying, and they kept buying, they kept buying, they kept buying, and mortgage rates kept going lower and lower and lower and lower. And they were driven so low to the point where we've never seen it, because the feds were buying mortgage-backed securities and artificially bringing mortgage rates down because there's no market for them. Well, now what's happening is they're selling those off now, and mortgage rates are coming back to normal, and they're continuing to sell those off. So now we're kind of seeing a normal world. But to get mortgage rates down there has to be something crazy like a COVID shutdown or something massive like that to happen. So now, would war bring down mortgage rates? Most likely, because that is a very uncertain thing, and there's a flight to safety into long-term returns, which is the bond market. So we'll have to kind of see what happens there. That's another fly in the ointment that could impact things. Old monkey wrench in the engine, so to speak. So anyhow, expect same old for now. We really need to watch employment. We want to watch inflation, and then the overall consumer sentiment. If it continues to weaken, mortgage rates will continue to get better. So that's it for today, guys. If you have any other questions, I'll hang on for a little bit. Otherwise, have a phenomenal week. And thank you guys all for your referrals. And I want to always just thank you for helping my team always stay in the top 1% in the nation. You guys have been wonderful. And again, my job is to make you look good so that you will continue to get those referrals as well. So have a phenomenal day, guys, and we will be in touch.
Thanks, Sean.
Anytime, guys. Have a great day.